costs come in our production phase with the new machine ignition. There will be a lot of savings in production of postage using that. The salvage value of the new machine is estimated at actually it's 100,000, and then it's used by additionally, farm provides great appreciation on a straight line basis. Cost of capital is 15%. Operation tax payments are really worse. That's really the right
So using the net present value approach, advise the farm on the replacement what? So they choosing or they want to replace one asset with another, but at the end of the day, you only replace an asset with another if it makes economic sense. Remember the rules of NPV, we said that you only accept projects that will give you positive what? NPV. So if replacing and buying this new machine results in positive NPV, we are going to replace that particular what? Asset. But the steps we said you must follow. The first step we said is you must determine your what? It said the thing we said you must. Yeah. Or when you're using the NPV, you know it is your present value cash inflow minus your initial amount outlay. Yes. But here we must determine our initial cost, determine our cash flows, and also determine our terminal what? And I remember I will give you a table or the format of how you determine each individual component there. We gave you the initial cost, we give you how you determine terminal cash flows, we also gave you how you determine your what? Your annual cash flows. Let's start by determining our initial investment what? Our initial cost. Let's determine our initial cost. Let's get our initial cost. Now the initial cost will be the same. What do you consider? So go to your table. Go to the table you wrote. Go to the table you wrote on Saturday. There is a table you wrote on how you determine your initial what? Cost. How you determine your initial cost. Tulisema unaanzaga na nani? The purchase cost. Okay? The purchase cost. Of the new machine. Now in this case, you're using with replacement. So you start with the purchase cost of the new machine. And how much is the purchase cost of your new machine? How much is the purchase cost of the new machine? Wanasema the second paragraph. The new machine will have an initial cost of how much? 1.2. So it's the new machine, not the old one. Then we say, what else do you add? Capital cost. So does the new machine have any capital cost? Does the new machine have any capital cost? For example, customs duty. For example, installation costs. The new machine. None. What else do we add? What else do we add? Any increase in working what? Capital. Do you have any increase in working capital in that question for the new machine? Any increase in working capital for the new machine? Anywhere? Remember, working capital is the difference between current assets and current what? Liabilities. So there was nothing on capital costs. There was nothing on working what? Capital. But because this is a replacement, what else do we include there? What else do we include there? In your format, there is something else you include because you're replacing an asset, you're abandoning one and using the other. What else? Format lazima iko mahali. Disposal process of what? In the format you wrote, already so far with the replacement. For replacement, you have your purchase cost, capital cost umeona hakuna, si ndio? Then your investment in working capital you don't have. However, you need disposal proceeds of the old ones. Less disposal proceeds of old assets. Of old assets. How much are your disposal proceeds of the old assets? How much are your disposal proceeds of the old assets? The same, the second paragraph. However, if replaced, the existing machine can be sold in the market today for how much? For 300,000. So if you to sell this asset right now, you would earn how much? 300 what? Then after that, what else after your disposal proceeds? Tax savings or expense. Okay, tax savings or what? Or expense. Tax savings or expense. So the point we do so that we see whether you are saving tax or not, we need to determine the net book value of the old asset. We need to determine the net book value of the asset. Then compare the net book value with the disposal. So, and repeat, the tax savings here or expense are as a result of disposing an asset at a higher cost or a lower cost than the net book value, value. So you're comparing the disposal proceeds of the old assets and the net book value of the old assets. Remember, when you dispose something, you have to pay what? Tax. So if you dispose at a loss, that means your tax is what? You can get a tax or savings. If you dispose at a gain, you're going to have a tax expense. But we must compare the net book value of the old and the disposal proceeds of the old, so that we see whether we disposed at a profit or we disposed at a what? At a loss. But let's start by determining computation of tax what? Computation of what? Tax expense or what? Or savings. Same. Do that. You compare the disposal what? Proceeds of the old. Disposal proceeds of the old ni ngapi? Disposal proceeds of the old ni kazi ya macho hata iko kwa board ni ngapi? Is it 300,000? Is that 300,000? Yes. You compare with the net book value of the old. Net book value of the what? The old asset, the one you're disposing, of old. We know that the net book value of an asset is normally the cost minus the accumulated what? Depreciation. The cost of the old asset is this is cost minus accumulated depreciation. The cost of that asset was 825,000. We need to determine accumulated what? Depreciation. And we know accumulated depreciation, we take the depreciation per annum, you multiply by the number of years that that asset has been put in use. Sawa? Walikuwa nasema aje kuhusu depreciation? Walikuwa nasema the old asset, tuko kwa old asset. Olivia? Wanasema that The machine was bought at age 25, then the machine was expected to have a useful life of 10 years, an estimated salvage value of how much? At the end of the we want the accumulated what? Depreciation. But to do that, we need part to determine the depreciation per. The cost is how much? 825 minus your salvage value wanasema ni ngapi? 40,000. You divide that by the useful life, which is how many years? 10. That is the depreciation per amount. But this asset has been put in use for how many years? For 5. So you multiply here by what? 5. So that will give you your accumulated what? Depreciation. So the first one in here of 825 minus 4 divided by 10 is the depreciation charge per. Then you multiply by the number of years it is being put in what? How much? Minus 875. 420. That's 432. 4, 2, 5. That's 2. Right. Now, it's currently valued 432,500. But when you sell that asset, you're going to earn how much? 300. So the difference is how much? It is a loss on disposal. Is it a loss on disposal? Is it a loss on disposal? You have sold it at a lower price than the current net book value. So you're making a what? A loss. So how much? 500. Yes. Is that 1,500? 30% of 132. How much? 39,750. So by disposing that asset at a loss, you're saving tax expense of 39,750. You're saving tax expense of 39,750. So when there is a loss on disposal, yeah, you save what? Tax. You save tax. So how much is that? How much is your initial cost? Cost. How much is that initial cost? 999,728. That is the present value cash out of that particular amount, of that particular asset, of that particular asset. The next step, what are you doing? Next step, what are you doing? The next step, what were you doing? The next step. Annual cash flow. Let's get the terminal before annual cash flows. Let's get the terminal cash flows before annual cash flows. Even into the terminal what? Cash flows. Let's get the terminal cash flows before. So go to that format of views. Go and format terminal cash flows. Go to the format of terminal cash flows. Terminal cash flows, remember we said these are the what? These are the amounts you expect to realize at the end of the useful life of an asset. Sawa? So I want you to tell me ni ngapi. So unaanza na nani? Unaanza na salvage value of what? Of which asset? Oh. Salvage value of which asset? Salvage value of which asset? Go to replacement of the new asset. Of the new asset. What is the salvage value of the new asset? What is the salvage value of the new asset? The salvage value of the new asset. Of the new assets, not the old. Of the new assets, not the old. It has a salvage value of how much? The salvage value of the new machine is estimated at $100. Yes. $100? Yes. And then, what do you consider? Did you have any recovered working capital? No, the recovered working capital will go part of the initial cost. So remember, you also add your working capital to the initial cost, but we did not have the next one.
Salvage value of all assets.
Less salvage value of all the ones. Less salvage value of all assets. And the salvage value of the old asset, will it put it down? Yes. What else? Then cash flows. We'll get you some cash flows. Cash flows are coming up. You got 60,000. Yes. You got 60,000. That is 60,000. Thank you, Njao. All right. The next thing we need to determine our what? Our annual cash flows. We need to determine our annual cash flows. So the annual cash flows, we start with the increase in what? Sales, less increase in variable cost to get your incremental contribution, less your fixed cost to get your earnings before profit and what? Tax. You less your tax. You also add back your depreciation tax. Should. So let's go to that question. Let's go to that question. The same. Now we're going to analyze the new machine. So the new machine is the one you're going to analyze. Now, as a result, the second paragraph, A new machine will have an initial cost of 1.2 and will have a useful life of 5 years. As a result of increased efficiency that will rise due to replacement of the existing machine, the firm will save 168,000 shillings per what? Per annum. In production costs throughout the new machine's life. Apart from that, in addition, there will be annual savings in reduction of wastages estimated at how much? So they are saving costs of production and they are also saving costs by reducing what? Wastages. So to say that. Kwanza ni nani? Production. Ya pili ni nani? Wastages. Production per annum, they are saving how much? 168. And they are also saving how much? 80,000. So that you increment on savings. So they saving in total. How much are they saving? To 48,000. So that is what is resulting in an increase in what? That savings is the one that is resulting in an increase in your earnings, Increase in earnings, which is your earnings before depreciation and what? Say, before depreciation and tax. Before depreciation and tax, the incremental savings. So in this case, they did not give you what? Revenues. They also did not give you variable cost. Instead, they went straight and give you what they are saying. Say they are earnings. And then to that, we normally we less our what? Our tax rate. Our tax. Are we saving our tax? Or rather, are we, after getting the earnings before depreciation and tax, the next thing you must determine is your what? Your tax. So give me your tax. They were saying somewhere, it is 30%.
Yes.
It is a 30%. So niambie hapa ni ngapi? Get earnings after what? You pay earnings after tax. Okay, earnings after tax. How much? How much are you taxing? What is 30% of 240? 74? 400. Alafu kuja less hapo. Kupe earnings after tax ya ngapi? 173. 600. No. So then to that, we normally add our depreciation tax on. Hapo tunaongeza nani? Hapo tunaongeza nani? You add back what? Depreciation tax. Depreciation tax sheet. And how do you get your depreciation tax sheet? You get the depreciation per annum times the tax rate. See now, all right? The depreciation per annum times the tax rate. I think we can compute that. Yeah. Let's compute the depreciation per annum. Get the depreciation per annum. So, give me the BTS or the depreciation per annum of the new machine. Of new machine. Get for me the depreciation of the new machine. Get for me the depreciation per annum of the new machine. Of the new machine. You're getting for me the depreciation per annum of the new machine. How much? To 20,000? Umechukua nini? 1.2 million minus salvage value of how much? Divided by 5. Umesema ni 2 million.
Yes.
Alafu upate depreciation per annum of old machine. So where there is a replacement or an abandonment, the DTS will be the difference between the depreciation of the old and the new one. Yeah. The old machine ilikuwa ngapi? Ilikuwa 825 minus salvage ilikuwa what? Divided by
10. So we take by
depreciation ingapi? Hii side nyingine. How much? 41. So the DTS will be 30% of 141. How much? 42. Kuja hapa tuseme 42.
So when you look at the minimum of the day was 15,000. And the minimum was of the beginning will be 30,000. There's a reality.
How much?
Now, there
Yes. Then we now that you have our initial costs, our terminal cash flows, and our annual cash flows, we need then to determine our what? We need to determine our NP. We need to determine our NPV, which you know is the present value cash minus your what? Initial outlay. Your annual cash flows are here. This is how much? 216,000. This amount is an annuity. The reason being, the savings are every single one year. For how many years of that asset? For 5 years. So it is a what? Is an annuity. So go to your question. So using the annuity factor, get for me the present value of that amount for 5 years. For me, this is 7,400. So go, it is an annuity, so you want the cash flow. So go to your tables, for 5 years using the annuity factor. How much is it? using your annuity factor. How much is it? 5 years using your annuity factor. Remember, this amount is being received every year for 5 years. 3.
For three.
Or 3. 3. 1 lakh. Plus your terminal cash flows. Your terminal cash flows. Your terminal cash flows are here, 60,000. But this we know they are received at the end of the what? Of the useful life of an asset. At the end of the useful life of an asset. So they are a lump sum amount, not an annuity. So go to your tables and discount for me these terminal cash flows, or you identify the present value interest factor at the end of the 5th year. This is a lump sum or a single amount. So you're using your present value interest factor of an annuity at the end of the 5th year. 0.94. So that is what will give you your present value what? That will give you your present value what? Cash inflow. You less your initial outlay. Your initial outlay. Your initial outlay was 999,750. What's your NPV? And revealing up. How much is your NPV? Your NPV. NPV. How much? It's a negative what? Hapa ni ngapi? Hapa. The present value cash inflow, you're adding this on here. Summit.
772,
772, right?
15.07.
Ndio negative. Ala.
And one with 166, 864.
Hapa juu ni ngapi? 216 times 3
Was 74.
74.
721. 721.
For 3 years. And here be
169, 64.
164. Give you right? Yeah, okay, add.
85.3.
885.3. Negative 166. 0.7. Yes. Remember, right, but you know the rules of NPV, you only accept index that generate positive what? Cash flow. So that is a negative. So you tell them to do what? Don't replace them. You tell them not to do what? Not to replace, because it is giving you negative what? You may compare negative what? NPV. Don't replace the asset. Go to November of 2020. Question 4A. November 2020, question 4A. November 2020, question 4A. Sorry.
November 2020, question 4A. Landa Engineering Works Limited, level, contemplating the purchase of a new machine with replaced the existing machine was purchased 2 years ago at an installed cost of 500,000 shillings. The machine was estimated to have an economic life of 5 years with nil salvage value, but a critical analysis of the performance now shows that it is usable for the next 5 years with a resale value of 100,000 shillings. The current disposal value of the existing machine is 200,000. The new machine will cost 600,000 and require 50,000 initial costs. Installation costs. Since the machine is not locally available, the company plans to import it and will pay import duty and freight charges of Kenya shillings 150 and Kenya shillings 100,000 respectively. The new machine shall require overhaul at the end of the third year, which is expected to cost Kenya shillings 100,000. The overhaul cost is to be amortized on the straight line basis over the remaining useful life of the machine. To support the increased business resulting from purchase of the new machine, accounts receivable will increase by Kenya shillings 250. Inventories and accounts payable shall increase by Kenya shillings 200,000 and 300,000 respectively. At the end of 5 years, the new machine will be sold for Kenya shillings 250. The estimated profit before depreciation and taxes over the next 5 years period for both machines are given as follows. Year 1, existing machine in Kenya shillings, thousands, and then new machine. Additional information. The corporation tax rate is 30%. The company uses straight line method of depreciation. The cost of capital is 13%. 4. Capital gains are tax exempt. Question: required the incremental initial cash outlay from 2. The incremental net operating cash flows associated with the proposed machine replacement from 3. Should the existing machine be replaced? Justify your answer.
Sama. Again, we already start by determining our initial what? Our initial cost. We have our initial cost. So the purchase cost of the new machine. Purchase cost of the new machine is that. How much is your purchase cost? The new machine will cost 600 watts. Then to that we say you do what? You add your capital cost now. You do have any capital costs? Capital cost are the cost to incur to put an asset into a usable what state. For installation.
Yes.
Installation umeona ni ngapi? Installation umeona ni ngapi? Sit down. Sit down. The next one. Since the machine is not locally available, the company plans to import and will import and freight charges. So to just work imports. Import and freight charges. Import charges ni ngapi? 50. Freight ni ngapi? Do you have any other capital costs? Any other capital costs? Capital costs? What's the depreciable cost? So depreciable cost is that 300,000. Capital cost is 300,000. So that your depreciable cost is 900,000. Well, so now So remember, the initial cost plus the installation cost will give you your depreciable what? Cost. So now, what else do we tend to record? Wanasema, the new machine shall require an overhaul at the end of the third what? We have a cost known as overhaul cost. The cost of overhauling that asset. Yeah. This overhaul cost, yeah, is being incurred at the beginning of the third year, not the beginning of the first year, at the beginning of the third year. But remember, these costs, the initial outlay costs, are being incurred in the beginning of the first year, when you immediately buy that one asset. But because this overall cost is not being incurred when you immediately buy that asset, you have to discount it. Because it is being incurred after you have purchased that one asset and used it for about how many years? 2 years. So we discount it. So to say, this is the 100 what? You discount it at the cost of capital, which was how much? The cost of capital is what percent? The cost of capital is what percent? 13%. But for the third what? For the third year. So go to your tables. You're discounting the overhead cost that year. You're discounting the overhead cost the third year. It's a single amount, not an annuity, because it is not being incurred per annum. It's only being incurred once in that third year. So it is a single amount or a lump sum. So you use table 1 or table 2. You use table. That table just give you the value of 0.6. 931. The present value interest factor for the third year. Because it is not, because that overall cost is being incurred in the third year. But our initial cost, all of them are at the beginning of the first year. So that is why you are discounting. The one for a non-annuity, for single, or non-annuity. We're using for non-annuity. Yeah. So, I hope you have understood why you have discounted that. Because you have incurred it in the third year and not at the beginning of the first year. But in case one come and say the overhaul is being incurred in the first year, having a discount. So but in most cases, the overhaul cost will always be incurred after you have used an asset for some particular number of what? Of years. So remember to discount. All right, so here you go. $69. So that is your overall cost. So then we also add our working capital if it is there. We're going to working capital. Working capital. Is there anywhere they have told you of working capital? Yes, they told you something on working capital, but they did not tell you this is working capital. But you know what is working capital? It is the difference between current assets and current what? Liabilities. So is there anywhere they have told you information on current assets and current liabilities? Yes, so to support the increased business resulting from purchase of a new machine, accounts receivables, accounts what? Accounts assets or liabilities would increase by 50,000. Inventories, asset liabilities, assets, And accounts payables, you know, are what? Shall increase by 200 and 300,000. Give me the working capital. Give me the working capital plus. Give me the working capital. Umesema ni ngapi? Remember, it is the current assets minus current what? Liabilities. Umesema ni ngapi? 150. Current asset minus current what? Liabilities. So 150 is enough. So this is current asset that indicate hapa ni current asset minus current what? Liabilities. So chapter hesabu hapo inakuja 150,000. Yes. 50,000, eh? You have added your what? Your receivable plus your stock minus your what? Payable minus your payable. Hapo tuko sawa? What else do we tend to record there after working capital? After working capital, what else do you tend to record?
And we get initial use.
There's something else. The old asset. Something was happening with the old asset. Something was happening with the old asset. I remember we were following the format when you card. For replacement, that's you have specifically when you read a person and they are replacing one machine with the other, the format you follow is strictly for replacement. Kuna purchase cost, kuna capital cost, kuna depreciable cost, investment, then disposal proceeds of old. Did you have any disposal proceeds of old assets? Do you have any disposal proceeds of the old assets? Disposal proceeds of old asset umeona ni ngapi? 100?
200. Disposal. Value system shares.
200 cents. You less, eh? Umesema ni 200,000, sio?
Yes.
Sawa. Then what else for replacement? For replacement, what else? Tax savings or expense? The tax savings or expense? Tax savings or expenses. And we say, why do you determine the tax savings or the tax savings or expense are determined because of loss on disposal? Or failure on disposal. And say there is something you must do. Simply do. We say about the do class. Ati unafanya namna gani? You must determine the net book value of the asset you are disposing of. And the asset you are disposing of is the old one. Machine. Then compare that with the net book, the loss with the what? You get the net book value of the asset you are disposing, compare with the disposal proceeds from that asset, then you either get a gain or a loss on disposal. Tafuta niambie ni ngapi? Tafuta niambie ni ngapi? You are comparing the net book value and the profits from the disposal. The profits from disposal.
Divided by 4. Divided by so everyone go around the place. Outside we are able there is around the 15 feet. 3.3. According to this, you need to get 3.3.
Others or again.
The net book value is 200.
The disposal process.
The net book value is 260.
The net book value. The net book value of the older. Remember, it's the older. The net book value. The cost of that asset will go to Sangapi. 500
minus 100 divided by 5 times 3.
How much?
Then
It's saying the machine was estimated to have an economic life of 5 years with nil salvage value. With nil salvage value. So give me the net book value. Give me the net book value.
12.
Give me net book value.
5. And you get 5 1 or 2, you get 1 7. 1 you get 1 7. 1 9 you get 2.
How much? 69 10. Ningapi.
Yes, 200.
Gain on disposal or loss on disposal? You're getting a gain or a loss? Disposal process is ningapi?
200.
So now 200,000, eh? So then you get the net book. of what? Of gold, sawa? The cost ilikuwa ngapi?
Yeah, 500.
We know the net book value is normally the cost minus accumulated what? So that is the cost, it's a product of accumulated depreciation. The accumulated depreciation is based on straight line basis. Yeah. So it is 500,000 minus annual salvage value. So now that asset was being used for how many years? 5. So now, but it is being used for how many years currently? It has been purchased 2 years ago. Yeah.
It's 200.
So this is 200, 300. That is 300,000. So is it a gain or a loss in the source? This is the loss amount of how much? A loss on disposal of how much? 100,000. 100,000? Yes. So now, the disposal proceeds, wanasema, the current disposal value of the existing machine is 200,000. If you sell it right now, you're going to earn 200. But the value at value is at how much? 300. So you selling it at a price below what you should be selling. So you making a loss of 100 dollars.
Yeah.
So this is 30% of what? 100. Inabaki kuwa ngapi? 30 down. That's nothing. What's the initial cost? What's the initial cost? What is the initial cost? Let's go to terminal cash flow. Let's get the terminal cash flow now. Terminal cash flow is ngapi? Terminal cash flows, we start with the what? Terminal cash flows tunaanza na nani? Salvage value of what? Of new assets. So tuandike hapo salvage value of who? Of new. The salvage value of the new ilikuwa ngapi? At the end of 5 years, the new machine will be sold for 50,000. So 50,000. Umeiona? Okay, go ahead. Everything that 50,000. They're saying somewhere just before the table, uko chini kabisa. At the end of 5 years, the new machine will be sold for. So, what else? Last. What else we include there?
So we try to go against next year.
We do not have a salvage value of the old scenario. What else? What else? We want our working capital. We're gonna need working capital. How much? Covered working capital, how much?
Hello, sir.
550,000. Ndio hii hapa. Sawa. What's the terminal cash flow?
Volume.
Yes.
How are we going to treat the resale value of 100,000 of the old machine?
I'll answer that in a few. I've seen your question. I'll answer that. Just give me a few.
Okay.
All right. Sawa. Sawa. Now, hold on. Wanasema the machine was estimated to have an economic life of 5 years with nil salvage value, but a critical analysis of its performance now shows that it is usable for the next 5 with what? With what? So it can be used for further years, but after they use it for further years, they will resell it for how much? 400,000. I hope you've seen that. So that is how you treat the salvage value of the oil.
Will it affect the depreciation?
No, it's not going to affect the depreciation. It's not going in any way to affect the depreciation there. Now you're seeing the depreciation. Yes. It is in the question somewhere. Iko wapi? The same. It is in the question. This just the introduction paragraph. Yeah. The second, let me say the third line. Let's read from the third line.
Machine was
Estimated to have an economic life of 5 years with nil salvage value. When they bought it, they thought they were going to use for how many years? 5. Yeah. And have a nil salvage value. After using that asset for 2 years, yeah, they have done a critical reevaluation. I noticed that the performance now shows that it is usable for the next 5. It could also be used for the next 5 years. So that machine has not been, it is being used effectively. Yeah? And if they use it for the next 5 years, it could be sold. For how much? Sawa? Sini sawa? All right. Give me your question. Yes. Yes. The first one is only used to determine your what? Loss or gain. So, because after reevaluation, how much will you earn from selling it? So, how much will you earn from selling it? Now that's clear. So the only information, the net value is on the current amount. The current amount. Well, up to where you have been using that asset. So get for me that the next step we said is you get your what? The next step to December is you get your what? Your annual cash flows? Annual cash flows. Umesema annual cash flows ni ngapi? 1, 300. Sawa? Let's get our annual cash flows. Remember, the annual cash flows are normally on an incremental basis. Yeah? They are normally on an incremental what? Basis. So you compare the earnings of the old and the earnings of the new. The reason you want to replace an old asset is because the new asset promises additional what? Cash flows. Otherwise, you not replace it. All right. So let's determine our annual cash flows. This is what they're saying. This is what they're saying. At the end of 5 years, the machine is sold for 250,000. When are you lying here? The estimated profit before depreciation and what? And taxes. Yeah. So here they have not given you the sales, they have not given you the what? Variable cost, they have not given you the fixed cost. What they have given you is the result of subtracting all that from your sales to get your earnings before depreciation and what? So to answer the earnings before depreciation and what? Yes. That is where we are. So in case of compare sales, the variable what? Cost. Ukienda na sales minus variable what? But remember on incremental basis. So you compare the new asset and the old asset. What is the increase? For example, in year one. In year one, let's go there. In year one, the existing machine, the earnings before depreciation and tax is 120. For the new machine, the earnings before depreciation and tax ni ngapi? 60. So what is the increase? What is the increase? 140? 140. See now. I'll have my figures in thousands of shillings of space. So allow me to have my figures in thousands of what? Shillings. The second year, the increase in ngapi? The existing is 150, the new is 280. What's the increase? 130. The next one? 220. 120. Hiyo ingine for the year 240 minus 145, that's 95. Alafu ya mwisho 270 195, is that 195? On incremental what? Basis. Sawa? Ukishafanya hivyo, what else do you tend to less? Those are the earnings before depreciation and tax. So what else do you place? In tax, so that you get your earnings at tax. You pay tax. You got How much? How much is the tax rate? Was 30%? That year 140 42. So that your earnings after tax in that 28. Give me the earnings after tax. Just give me the earnings after tax. Take 70% of what? And 30, 70% of 120, 70% of 95, and 70% of 135. Year 2 the earnings after tax 91.
91.
Next 84.
Yes.
This. Hii mwisho ni ngapi? Sawa. Hold on.
0.5.
What is 70% of 95? 0.5, eh? 66.5.
94.5.
94.5, zero. But what else do we have? B2. You have your earnings and returns. So the next thing we have to add is our DT. Our depreciation, that's what? Or depreciation, that's true. So get for me the depreciation tax sheet. Get the depreciation tax sheet. And we say you compare the old and the new asset. You compare the old and the new asset. And remember, the old assets did not have a salvage value at the beginning of the year. But now it has a salvage value of how much? 100,000. Has a salvage value of 100,000. Let me explain something. In the end of question we did, there was no way they were telling us that asset was reevaluated. So now, from this value, and they saw that we can extend the useful life of that asset. So, but in this particular question, they are telling us that that asset could be used for another how many years? Yes. So what you do, you first determine the net book value of that current asset before you evaluate the revaluation. So that asset had been in use for how many years? 2 years. So you get the net book value as at the end of the second year. That means it is the beginning of the third year. So let's get that. We want to get your depreciation. I'm talking about the what asset? The old one, or the existing. I want to show you how you deal with this. You want to compute your what? Computation of what? Depreciation tax sheet. You just run out of time. It's something I want to highlight because of the difference in wordings in the question. Whether it's a revaluation or an evaluation, yeah, we first get the net book value. So we get the net book value of existing what? Existing or old sheet. So we ask ourselves, what is the accumulated depreciation of that machine? And you the net book value of the old. Do 301,000. You have minus, we already have it here. It's 301,000. But remember, depreciation is normally on what? Or DTS is normally on depreciation per annum. So when we want our depreciation, we'll say, yeah, they were using straight line what? So you know it will be the current net book value of 301,000 minus the salvage value after evaluation. And they were saying that that asset could be disposed for how much? 100,000.
Yes.
It could be disposed for 100,000. Yeah. And it could be used for how many years? 5 years. How much is your depreciation per annum there? It will be used for 2 years, after which the net value is how much? 300. And now they have revaluated and noticed that they could use it for another 5 years. So if its current net book value is 300, it could be disposed for 100. How much? How much? 40,000. That is the depreciation per what? So then say compare this with the depreciation of the existing what? Of the new machine. The depreciation of new machine. Give me the depreciation of the new machine. Give me the depreciation of the new machine. Give me the depreciation of the new machine. The depreciation of the new machine. Was it also being depreciated on straight line basis? I'm gonna do me a straight line, yes or no? Yes. Yeah. Notice how much the company uses straight line method there. So you take the cost minus salvage value, divide by useful what? Like what's the cost? The cost is the depreciable cost of 900,000. The machine of 900,000 in the depreciable cost, not the party's cost. The party's cost plus capital cost. They are compared depreciable what? That is what you use to do what? To depreciate your asset, not the cost. Then it's the depreciable what? The cost plus capital minus how much was the salvage value, then your asset. At the end of 5 years, the machine will be sold for 250. For 250 now? Equally, yeah, it could be sold for 250, but at the end of 5 years, yeah, therefore divide by 5. That is out. On that now, yes, is it on that now? Then there was also another issue in that question. The other issue is amortization of overhaul what? Costs. When there is an overhaul cost, you normally depreciate it from the year when it was incurred up to the end of the useful life of that asset. From the year when it was done or incurred. So, for example, this overhaul cost was worth 100,000. So you got 100,000. Was it 100,000? The overhaul cost?
Yes.
Yes. So, you spread it over the remaining useful life of that asset. And the remaining useful life of that asset, it was incurred at the beginning of the 3rd year. But the useful life of the asset is 5 years. So it will be depreciated over how many years? 2 years. So we divide this by what? What is that? 50,000? Yes. 50,000?
Yeah. But teacher, we don't consider after evaluation the useful life of the machine. As I say, show that it's useful life of 5. It's useful for the next step.
Yes, but it is regarding the 3rd year.
Okay.
So 5 minus means 2. Your DTS hapa tasema it is 30% times 130,000 plus 30,000 plus what? 50,000 minus 50,000. So remember, for the older assets, you do what? You do what? Subtract. You subtract. I mean, let's do that first. Minus 50,000. I'll show you. Then overall costs. DTS 30% is 50,000. The reason we've done that is because this overall cost, remember, we're only going to depreciate it or amortize it for how many years? 2 years. The 4th and the 5th year. But this depreciation here per annum is for how many years? 5. It's for how many years? 5. So this amount here, which is how much? 15,000. 15,000. This one here, we are going to charge it for how many years? For in the back and the fourth what? Here. No, in the 4th and 5th year. In the 4th and 5th. But this amount here, meaning up here, 27,000. This will be cut per annum. We're going to charge it per annum. This is how you're going to do that. Utasema 27, 27, 27. Lakini sasa in the 4th and 5th uchukua 27 plus 15 ingawa 42. Is that 42? Which is 27 plus what? 15, eh? 27 plus 15. 27 plus 15. What's that? So that is how you treat what? Overall what? Cost. That is how you treat overall cost. So remember to amortize it over the useful life of the asset. Over the, not the remaining useful life. So the remaining useful life. Over the remaining useful. This overall cost is being incurred by the new machine, Not the old, it is being incurred by the new machine. Not the old, it is being incurred in the that year, so you amortize it over the remaining useful life. You amortize it over the remaining useful life, which is the 4th and 5th year. And the BTS, the normal one, of 27, kumbuka kuongeza overall cost ya 50 in the 4th and 5th year. For the 5th year. After you have done that, you get your annual what? You get your annual what? What's your annual cash flows? What's your annual cash flows? Sawa? So I want to believe mtamalizia hapo mengine. Remember, this terminal cash flow, go happy, you will charge it at the 5th year. So you're getting your what? Present value cash inflow. So utaongeza hizi, discount hizi ya. Alafu hii terminal cash flow, remember it is incurred at the end of the useful life. So you discount it at year 5. Sawa? Then you subtract what? Your initial cost to get your NPV. Sawa? Alright, mtamalizia hapa. Mtamalizia, in case of anything, refer to the previous question. So remember hizi ndio tulikuwa discount ndio tupata present value cash inflow, alafu unaongeza nini? Terminal cash flow, but hii kumbuka una discount at the end of the useful life. 5th year, terminal cash flow we say is received at the end of the useful life. Sawa? Alafu una subtract initial cost ikupe NP. Sawa? Refer to the previous question. Sawa? Don't have enough space from my end. So in your own free time, you look at September 2021 question 2B. September 2021 question 2B. In your own free time, you find your September 2021 question 2B. But that question is depreciation on reducing balance. Is depreciation reducing what? Balance. But remember, when you're getting DTS, depreciation is DTS is depreciation per annum times the tax rate. It is depreciation per annum times what? Tax rate. So you must get the depreciation using reducing balance for every year. For year 1, upate, for year 2, for year 3 until the end. Alafu that depreciation per annum, you now charge DTS. That means the DTS for year 1 will be different to year 2, to year 3, to end the end. Because the depreciation is on reducing balance. So, plus also be careful with the overhaul what? Cost. Remember to amortize it over the remaining useful life of the assets. Remember also, if it was incurred in the middle of the useful life, you must do what? You must discount it. So, also remember on revaluation. On revaluation, yeah. Any revaluation of Zada to get the differentiation. You look at that. That is September 2021 question 2B. So it's out. It's out. Let's look at that. Then I think we can call it a day. See you on next class. Nearly. Utaambiwa. Si ni sawa? Utaambiwa. Probably Friday, we will not talk, but we will see. Si ni sawa? We will confirm that before then. Alright. Kuna swali?